G'day everyone, my name's Greg Canavan. I'm the editorial director here at Port Phillip Publishing. Today we're here to talk to you about the historic moves that we've seen on the markets over the past couple of days. I'm joined by my friends and colleagues Dan Denning and Shae Russell. You might know Dan. Dan originally set up Port Phillip Publishing back in, I think it was 2005, was it?
Yep.
And was with the company for 6 or 7 years and then has been wandering around the world looking for interesting investments and currently writes on the Bonner Denning letter and is in Australia for the next couple of months to investigate. What are you here for, Dan? Just checking out the country, investigating a few options out here?
Well, I thought it was going to be a holiday because I became a citizen when I lived here before, and I've tried to come down regularly since then. So this would be my longest stay, but it's turned into a bit of a working holiday.
Absolutely. Well, welcome anyway.
Thank you.
And I'm also with Shae Russell. Shae has a couple of publications with us, being the Hard Money Trader Service and Rock Stock Insider. And Shae is our resident expert on gold. And we're here obviously going to be talking about a number of things, but gold will be your specialty today. So
Certainly.
Thanks both for joining us. So let's get into it. The reason why we're talking to you today, obviously, is there's been some major moves across the market, starting a couple of weeks ago, but really culminating in some big falls on Monday and Tuesday, with the oil price effectively collapsing by 30%. And when you've got such large falls in such a major asset market on the back of the panic and fear over the spread of the coronavirus, it really culminates into a very volatile mixture for asset prices. Stocks, gold, oil, bonds, everything's moving. So let's try and make a little bit of sense of it. I'll start with you, Dan. Can you help us work out what the heck is going on?
Well, I can try. I think this reminds me a lot of 2008 and 2009. But there are a lot of traders and investors who either don't remember that or weren't in the market at that time. And I was looking back at the numbers today, and since the bottom on the S&P 500 in March of 2009, it was March 6, 2009, and the bottom, the intraday low on the S&P was 666, and then it's gone up since then, mostly because of these unconventional central bank policies. So I guess my point is we had a 10-year bull market, at least in the US, that went up almost 400% in blue chip stocks.
Yep.
So they say that bull markets don't die of old age. But I think what happened in the last 2 weeks is the discovery of this virus in China and the discovery that it might have a very large effect on the global economy in terms of supply chains and, more importantly, in terms of company earnings. That was the catalyst for what I would have expected to happen anyway, which is a bear market,
Yep.
or at least a normal correction. And really, we're 20%, almost 20% off the highs in the S&P. But I don't think what anybody expected was after the virus thing to then have a record plunge in bond yields, then this collapse in the oil price. So I think it would have started as an expected correction in stock prices, and now it's turned into something much different.
Free fall, more or less, in a panic. Shae, what's your take on recent events?
Look, the recent events that we're seeing in the stock market, I actually expected to happen about 4 weeks ago, and this is when we first got wind of the virus. So as I was writing over at the Daily Reckoning Australia, I was shocked that the market hadn't pieced together what this virus impact meant for the global economy because we're so interconnected now. So I was expecting the falls back then, and I believe we're seeing obviously a delayed reaction from finding out of the virus and the severity of the virus to now. I've had the blissful ignorance of being away for the past 4 days camping, which was lovely in the fact that I haven't had headlines bombarding my thoughts. But I do think what we're going to see is that we're seeing some panic selling now as people are trying to process the news. But I don't think the panic selling is going to last too much longer. I think we just the investors sort of need to try and weather the storm for another week or two while people try and work out what the bigger picture really is and then start reassessing the full damage on the global economy, local economies, and then their own portfolios.
Well, I guess that's the question, isn't it? I mean, we went through a period of panic selling, I think, a week or so ago. based on the fears of the virus spreading and the effect on the global economy and the impact on airlines and hotels and just a general slowdown across the world and the effect that would have on earnings. Valuations at that point were already pretty stretched. And then you have the oil price stuff that's come on top of that, and then it's added another wave of panic in the selling we've seen over the past couple of days. Can you give us a sense of what the Saudis are doing to starting an oil price war at a time where demand is already falling off a cliff? The effect that that's going to have on the credit markets in the US, given the exposure to the shale producers and the debt that they've got. Is this another reason to panic and sell? And clearly that's what the market's doing now. I mean, like Shae said, are we getting close to perhaps a capitulation low here, do you think? Or
I don't know. I think Shae's quite right in that some of the move, especially on Monday, can be explained in terms of retail investors reacting with shock and horror at this thing in the oil market. But that's a next to the 10-year Treasury note. You know, the oil price is arguably the most important price in the global economy. It's the price of energy, and despite this big focus on renewables and the shift to a different economy, oil is still the main thing in the economy. So that, I think, has the potential to be both extremely disruptive and also quite possibly a huge opportunity. When you talk about not panicking and you see a 30% fall in the oil price, and then the energy sector here in Australia and in the US, those stocks sold off, you're looking at the possibility that you may not get a better time to buy those stocks in your lifetime. But that's assuming that this doesn't turn into a larger economic depression or worldwide recession. With respect to the Saudis, it's not clear why the Russians and the Saudis would both agree to try and increase production when there's not demand for it. So at that point, this is what Bill Bonner and I do in the Bonner-Denny letters. That feels to me more like a geopolitical story.
Absolutely.
And there's two ways of looking at it. One is that the Russians know that the U.S. oil production, the U.S. is the largest oil producer in the world right now, around 12 million barrels a day. That's mostly because of the shale drillers. And as you pointed out, they operate with a really risky financial structure. So that industry exists because of credit. And if you can crash the oil price in the middle of a financial crisis, then you have the real possibility that these companies can't stay in business. That shifts power in the oil market back to the countries with the largest proven reserves. So it's a power play to shift pricing power back to producers and take that away from the U.S. There's also what I've read online in certain places, a theory, I suppose, that it could be the Saudis trying to take advantage of the Iranians right now, that they've been hard hit by the virus and their political leadership. They've been suffering crippling sanctions, but they rely on oil as the chief generator of foreign currency to run their economy. And so we don't really know any of that, but we do know that everybody uses oil and energy. And so that move, anybody who was short oil on Friday would get a margin call. Similar with bonds, anybody who was long bonds and then saw this collapse in bond yields, that causes knock-on effects in the equity market that don't have anything to do with business earnings. It has to do with the amount of leverage in the system.
And that's where you get the indiscriminate selling.
Yeah, you have to sell. You have to sell what you can sell to either meet the margin call or cover a short position that's gone catastrophically wrong.
Just one other point on the falling oil prices, just to look at it from, there's not many silver linings around right now, but oil price falls 30% one day. I filled up the car the other day and it was already lower than what I remember it for quite some time. So you're going to see some really low oil prices, which in some ways does free up a little bit of spending for the consumer in this environment. I mean, it's not much, but certainly in an environment where consumption still accounts for 60% of the economic activity, or maybe 2/3 in most Western economies, that's at least a little bit of freed up spending power for the consumption-dependent economies of US. And
hopefully everyone won't be quarantined in their house, so they won't be able to drive anywhere anyway.
Well, speaking of which, Italy has just declared a lockdown of their country, no public gatherings, all that sort of stuff. So this is just really feeding into the panic and the nervousness, isn't it?
Do you know, it's funny, a school mum stopped me as we were doing drop-off today, and one of her kids is going to a school that has announced they had one virus, so therefore they've just shut the school down for the week or until otherwise advised. And more than anything, she was cranky. She's like, it's not going to get it. There seems to be this irrational idea of, if we just shut the school down, we'll solve the problem. But really, that's just pushing the problem into other aspects of the community and, obviously slowing her down from being able to go into work, slowing her partner down. I think we're going to see more of those overreactions of what we're seeing in Italy, closing schools down here. That's really start of it. I mean, How long till Chadstone is shut down?
I'm not sure it's an overreaction, though. I think this is the part where we don't know, is that it's not so much, and this is the thing now too, is everyone suddenly becomes an expert on viruses and epidemiology.
That's a good point.
None of us really know.
Exactly.
But what we do know is that if you suddenly put a huge strain on the public health services because a certain part of the population is disproportionately affected by something, so mostly elderly people who now have to go into intensive care or emergency, it doesn't take much to fill up all those hospital beds. And it's probably not a surprise that in Japan and Italy, the two of the oldest countries in the world demographically, it's put the largest strain on those regions.
Yep.
Both wealthy countries, both Western countries, both with really, really good healthcare systems. But I think that's the concern is the knock-on effects to the rest of normal business in an economy. If your first responders and your emergency services people and your medical professionals are under the pump because the hospitals are full of people who probably won't die, but will need lots of care, then we've never been there before. That's not something any of us have dealt with. It didn't happen with SARS, it didn't happen with swine flu, it didn't happen with any of the other previous diseases that came out of Southeast Asia. But now it's happening in Europe, it's happened in China. I think that's probably the best news, is that if the numbers can be trusted, the number of new cases in China seems to have plateaued. So that would put the focus here and in the US and in Europe on not letting it get out into communities.
Well, that brings us to the next point I wanted to talk about is bond yields and gold, because this fear that's sweeping through society, and we see it almost comically in the stripping of the shelves of toilet paper in the supermarkets, but that's just a manifestation of the fear, and that fear that we're seeing in financial markets now as well. So you're seeing capital get out of risk assets, get out of equities and moving into gold and moving into sovereign debt. Shae, I'll ask you first, have you got any comment on the gold price moves? I mean, we'll talk about it in US dollars just because that's the benchmark, but also certainly comment on Aussie dollar gold if that...
If I control the waffle. Okay, so first of all, again, I was texting a colleague last night, and he was saying, well, why didn't it stay up over 1,700? I would have thought with all the fear in the market it would have. I've got a couple of reasons, or a couple of theories that I'm chewing on, I should say. The first one is that I think people are just desperate to move to cash, and I think that's what we're seeing with investors selling out of stocks and less so bonds and other investment vehicles. I think we're seeing people just move to cash. The other argument that I'd like to add there too is that there's been a huge run up in the gold price in the last 2 months. We've moved from, I think it was around 1540 at the start of the year to, a little bit over 1700. That's a really strong rally.
Yeah.
I wouldn't be surprised to see profit taking coming out of that US dollar gold price and driving it down even lower. I say this all the time, and I probably bore people, but when gold goes up in a straight line, it tends to come back down in a straight line. So with all the fear in the market, even though gold is the fear metal, there's going to be a slow reaction before we see a huge spike higher. But I would anticipate a sell-off in gold first before we see the next sort of leg of the metal moving up.
And that could be something that coincides with a bounce back in equity markets and a relief rally. So you sell the defensive assets, you get back into your risk assets. And whether this happens in a week or 2 weeks or even tomorrow, no one knows at this point. But generally, that's the way these things work, isn't it? You have all your capital flowing in to the safe havens in the time of panic.
Yep.
And then when people feel like that panic's over, the capital flows back out. So you're sort of saying a correction in gold, not necessarily an end of the run. It's just time to take some profits in that. Well, just on that, give us some thoughts on what you think the end game looks like for gold, or beyond, say, the next couple of months. What are we looking at?
Okay, so since the start of the year, I've been saying gold. I expect gold to sell off in March, and it's simply because it tends to have a cyclical pattern of after Chinese New Year is over, gold does tend to sell off in March for a little bit. Any sell-off in gold, though, I don't believe will last too long. I think it might take a couple of months before the rally gathers steam, or there's some sort of geopolitical event that sees people move back into gold. It might be a bit crazy to say this right now when gold's sitting at 1,700 an ounce. I wouldn't rule out gold falling back down below 1,600 in the short term. Nonetheless, that doesn't mean the bull market is over. This gold bull market is really only just getting legs. Yep. I like to think that gold's in the investor phase right now, and that's the way I like to describe it, a solid chunk of time where gold is really just gathering momentum. And by gathering momentum, it's drawing an investor interest. So I don't think people say there's going to be this huge doubling of the gold price, within the next 18 months. I don't think we're going to see a doubling of it. What I think we're doing is gold creating new support levels for its price to sustain a much, much bigger rally over the next couple of years.
So you'd certainly be saying that any sell-off that comes over the next couple of months would be an opportunity for you to look at those good stocks that have come back in price, take positions in them, add to your positions, that sort of thing?
Yeah, I think I joked before about how I'd like to go shopping for some gold producers. Yes, especially in Aussie dollar terms. If the Aussie dollar does stay as weak as it is, it's going to make the Aussie dollar gold price even more attractive. And we've got some very lean gold producers here in Australia. So I think once the panic is done and the sell-off sort of finds a little bit of support down the bottom, I'd be keen to look at gold mining stocks because, they'll be quite profitable.
Yep.
I'd like to think over the rest of the year.
Absolutely. Let's move on to, I guess, what is the inevitable conclusion of all this is a government/central bank response. We've already seen the RBA, they cut interest rates by 25 basis points. The Fed cut interest rates by 50 basis points. The next Fed meeting, I think, is the 17th, 18th of March. Whether they panic and cut before that meeting or not, I'm not too sure. But I know, Dan, you've got some thoughts on that. So really, just over a week, in a week's time, we'll be seeing the Fed at a press conference. What are they going to do? Everyone knows something's coming. We're just not quite sure what. A bit like Pavlov's dog, we've all been trained for this response, haven't we?
Sorry, I'm well. I'm not ill.
No fever?
No, not yet. That's a good question. I think when the Fed cut last week, I don't think there's a possibility they'll do that again before they meet. But I think given what happened last time, it looked more like a panic move. So instead of being a signal flare to follow us, it basically torpedoed confidence in the market. So, we'll have to watch that on a daily basis to see what the central banks are saying and what they're doing as well. But I think it's likely that they won't do anything until the middle of March, and then we'll see the meeting notes from the RBA, which by then will be a little bit out of date, but I would assume we might hear more from them before then, especially with the government coming up with a stimulus plan. But it's a really important point to not underestimate the willingness of central bankers to do crazy things.
Yep.
That's what happened in 2008. And those of us who were gold bulls at the time and gold bugs just figured that was it, that this was the big system reset that we'd been expecting for a long time. And they did something no one expected, and we got a 10-year bull market. So that's what we need to think about now. I think the important difference between today and 10 years ago, or 2008, was that when the RBA started cutting rates in 2008, they were at 7.5%, I think. And then they cut them all the way down to 3% in the next 6 or 7 months. The Fed started earlier, but it went from 6.5 to 0.5. So there's no room for that anymore. They can't cut rates. They can take them negative, and that's what the market has basically been doing itself. So this is a real problem for investors because the average portfolio in the U.S. anyway, in a 60-40 portfolio, is massively exposed to government bonds.
Yep.
And government bonds, in real terms, don't yield anything. So this is what's driving, I think, the long-term argument for gold is what can central bankers do to either prop up financial prices or get involved directly in stock markets. And will that be bullish for gold? Will it be bullish for oil? Will it be bullish for stocks? And really the answer is we don't know. When I was here, I looked at a theory from a former Fed governor named John Exter. And it was, if you recall, it was Exter's pyramid. Mm-hmm. And he described that in a financial crisis, liquidity in the system tends to disappear. But to the extent that it's mobile, it moves down the pyramid toward assets that are more like cash. So in his pyramid, you had derivatives and corporate equities at the top. Then you had corporate bonds. Then you had government bonds. But at the bottom of his pyramid was gold. That it was the only asset that didn't have a counterparty. It was not anybody's liability. And the criticism against gold has always been that it doesn't yield anything. Well, that's not a problem now, because if you're buying government,
it's in good company.
Yeah, it's got plenty of company. So my view is that that'll be the real contest: is do you see a shift in investor sentiment that drives the next phase of the gold bull market, where people start to own gold as part of their portfolio? Because right now, most people still don't. In my view, they just don't own it. They might own stocks, but they don't own physical gold. And institutions don't own it either, unless they own the ETF. So I would look for that in the next couple of weeks, but not to discount the possibility that central banks could do something. In theory, they can buy anything. Yeah. And the Fed has already floated this trial balloon about adding stocks to its balance sheet, the way the Bank of Japan does, or like the European Central Bank buys corporate bonds. That might become necessary if credit conditions deteriorate. So I would, we'll just have to look in the next couple of weeks to see what they're up to. But my view, personally for myself, is that either in a deflation or if all this eventually produces massive inflation, I want to own physical gold. Shae's the expert on the mining stocks, though, so I'll be listening to her because I'm not really sure how those, whether they lead or lag the gold price.
Yeah. Look, I think we'll leave it there today. We've had an interesting discussion, and we're going to continue this discussion in the days ahead. So I'd encourage you to keep clicking on the communications from Port Phillip and Fat Tail Media, and we'll try and keep you abreast of all the news that's happening in the market, because things are moving pretty fast. All right, thanks for tuning in, and we'll catch up with you again soon.